Hello. So we're gonna talk about the accruals. We're still discussing the adjusting entries. In our previous video, we spoke about the deferral, adjusting entries, and now we're gonna talk about accruals. The difference between them is deferral. Usually, the cash comes in advance, or the cash is paid in advance, and then the revenue or expense will happen in future. With the accruals, it's opposite. The revenue or the expense will happen now and the cash in future. Okay, so let's have three different examples for accrual entries, which we'll still consider them adjusting entries, and those are usually, we record them at the end of the month. So the first one, it's when we have salaries expense accruing. It means that, for example, we're at the end of a month, like January, February, and we usually do not pay the wages immediately to the employees the last day of the month. We pay them few days later. So let's say we're in the month of January, January 31st, we have to accrue the salaries expense, although we will pay them February 3rd, for example. So we do not wait until February 3rd to record the salaries expense, because we need that salaries expense to show up in our current month financial statements. So it has to be recorded by January 31st at the latest. So we're going to debit the expenses. As we know, every expense has to be debited whenever you record them. So we will say salaries expense debit. Remember, we always have to start with the debit first in our journal entries. And let's say that was $2,500. And then in the credit, we're not going to say cash because we didn't pay any cash. The cash will be paid later on in February sometime. So we will say salaries payable. And we've seen that in our first couple of videos. We know that whenever a payment that becomes due, it has to become a liability under one of the payable accounts. So this particular payable account is going to be salaries payable, because we will pay salaries in future. So we're liable to pay salaries. And then remember, any liability account has to be increased with a credit. So that would be credit salaries payable, $2,500. We've seen a similar example in the first videos. The only difference is that journal entry, usually we record it at the end of the month. Okay, so that's the first example. Another example, which is very similar to this, but this time it's interest. Interest that becomes accrued at the end of the month. It means it's due, but we're not going to pay for it immediately at the end of the month. We will pay for it sometime in future. Because if it was interest for a loan that we took from the bank, probably the bank is not in a hurry to get the interest now. They're not asking us to pay now. Maybe they want us to pay at the end of the year only. So we still have to record that expense, interest expense, at the end of every month, because I want that expense to show up in the financial statements for that particular month. Okay? The only way to show it in that particular month is to record it at the end of that same month. So let's say it was interest, it's an expense, so it will be debited. Any expense will be debited, so interest expense. Let's say that was $300, and then the credit it's also gonna be a liability account. It's gonna be a payable account, so we will call that interest payable. It will increase with the credit because it's a liability account. So both of them will say interest, the debit and the credit, as well as the salaries. Both of them will say salaries, but there's a big difference between salaries expense and salaries payable. There's a big difference between interest expense and interest payable. The expense is an expense account. It's money that we spent on something to operate the business. But a payable account, it's a liability. We're liable to pay cash for something. Okay. A third example, it's also something we did before. It's a revenue that we provide today, or we provided this month, but we're not going to get paid now, we will get paid in future. Remember, accruals means revenue or expense happens now and cash in future. So the moment we provide the service, we have to record that in our journal entry to show it in our current financial statements for that month, even if the cash will be in future. So if I'm not going to debit cash for a service that we provided, then we have to record accounts receivable instead. Accounts receivable means it's cash that will be received in future. And it's an asset, so it increases with a debit. So debit accounts receivable, let's say that was $3,500, and then our credit, we will say service revenue, $3,500. Okay. Now later on next month, if the customer comes back to pay the cash for the revenue we provided him, at that time we will do debit to the cash because we received cash. Cash is an asset, it increases with a debit. And then we credit the accounts receivable because accounts receivable has to decrease because the customer doesn't owe us money anymore after he pays us. Okay, but that's later on when he comes back to pay. What we're recording right now is the accruals only. Okay. All right, now those are 3 different examples for accruals. The next step in our accounting cycle, now that we're done with all the adjusting entries at the end of the month, the next step is to prepare the adjusted trial balance. Remember, we prepared the trial balance in our previous video, but that was the unadjusted because that has been prepared before doing the adjusting entries. Now that we have all the adjusting entries recorded, we have to prepare our second trial balance, which is the adjusted trial balance. It reflects all the adjustments we did. So adjusted trial balance. Okay, one more thing that we need to know that those adjusting entries that we recorded, they have to reflect on their own T accounts, just like we did in our previous video. They have to be reflected over there. I'm going to skip that part because, we already spoke about how to reflect transactions to T accounts from journal entries. So I'm going to go straight to the adjusted trial balance. Now, how do we prepare it? Where do we have to look? We need 2 resources to be able to prepare the adjusted trial balance. We need to go back to the unadjusted trial balance that we prepared in our previous video, as well as the adjusting entries that we recorded for deferrals and accruals. Now, we're going to reflect every transaction we recorded in our adjusting entries on the unadjusted trial balance, and we will come up with the adjusted trial balance. All right? So let's go back to the unadjusted trial balance. That was the one we prepared last time. We've got a couple of accounts. We've got cash, common stock, equipment, supplies, AP, service revenue, accounts receivable, advertising expense, prepaid rent, and unearned revenue. And some of these balances will change based on the adjusting entries. And we will probably need to add more accounts that were not existing before, and then now that we came up with the adjusting entries, they were created. So we're going to add them. Remember, the trial balance has to have each and every account the company is using, each and every account that has some balance in it. So let's start one by one. Let's start with the ones that we already have. So we have cash, common stock, equipment. So we've got the debit side, we've got the credit side, and then we've got cash, common stock, and equipment. And then if we look back at our adjusting entries, we will notice that nothing has been changed to the cash. So we'll just go back to the unadjusted trial balance and go ahead and pick the $84,300 balance for cash and just put it down under the debit side for cash. And then the common stock, that was $100,000, and the equipment was $20,000. By the way, when you prepare the trial balance or the either the unadjusted or adjusted trial balance, usually you start with the asset accounts first, and then liabilities, and then equity, and then revenue, and then expenses. I'm going to skip that part. I'm going to skip putting them in order. But usually, officially in accounting systems, they have to go in that order. Okay, and then after the equipment, we have supplies, and then the accounts payable. Okay, supplies, and then accounts payable. Okay, now supplies, it has $1,000 balance under the debit. Let's go back to the adjusting entries and find out if there was any changes. So here are my adjusting entries. Let's look at them one by one and just find out if there was any changes to the supplies. Yeah, we've got supplies here, and it was credited by $300. Now remember, if I have a debit balance of $1,000 and then we consumed $300 of supplies because I credited $300 of supplies, that means we have to decrease the balance by $300. So $1,000 minus $300. The $1,000 was a debit balance. Now I have a $300 in the credit side. Credit will be subtracted from the debit, so my ending balance will be $700 debit to cash. To supplies. So we go back to supplies in our adjusted trial balance, and now it's going to be $700. It's not $1,000 anymore. 1,000 minus 300 equals 700. Now, the accounts payable. What happened to accounts payable? It used to be $1,000 credit balance. Okay. And then let's go back to the adjusting entries and find out if there was any changes to accounts payable. Okay, it looks like there's no accounts payable, but we came up with different payable accounts. We came up with salaries payable and interest payable. So we're going to create separate accounts for those. Okay, so in the meantime, let me just go ahead and find out what was the balance for accounts payable and just copy it. It used to be $1,000 credit. I'm just going to copy the same thing because we didn't change anything in that account. Okay. Now that I have seen the all the other payables, so let me just go ahead and put them under the accounts payable. We had salaries payable. It wasn't existing before. So now we're going to create it and put it here in the adjusted trial balance. And then there was also interest payable. And because they were not existing before, that means they had a zero balance before. And then after recording the adjusting entries, let me go down and see what changes happened to them. Well, they used to be zero anyway. So salaries payable, $2,500 credit, and then interest payable, $300 credit. Okay. So I'm just going to copy these numbers and put them in the adjusted trial balance. 25 and 300. 25 and $300. Okay. All right, let me go back to the trial balance. What else do we have? Service revenue, accounts receivable, and advertising expense. Service revenue, accounts receivable, and advertising expense. Did anything change to any of those? So service revenue, let's just go down. There's nothing. Oh yeah, there's accounts receivable, service revenue here. It was credited by $3,500. So we need to add $3,500 to whatever balance we had for revenue. Oh, there was another one here. Service revenue, that was also an adjusting entry, $1,000. So 35 plus 1,000, that's $4,500. And then in our unadjusted trial balance, we had $7,000 balance in the credit for service revenue. So 7,000 plus 3,500 plus 1,000, that will be 11,500. Okay, 11,500 for the service revenue. 11,000. It was a credit balance. Remember. Okay, so that was the 7,000 plus 1,000. That's 8. 8 plus 35. That will be 11,500 for service revenue. All right. What about the accounts receivable? Let's go back. Accounts receivable balance used to be $3,000 debit balance. And then let's go back to the adjusting entries and find out if there was any changes to those, to the accounts receivable. I don't see any accounts receivable in the adjusting entries so far. Scroll down. There you go. Here's an accounts receivable all the way down at the bottom. $3,500 debit balance, so we have to increase it by 35. Okay, remember, asset increases with a debit. So accounts receivable is an asset. It increases with a debit. Okay, go all the way up. What was the balance? 3,000 plus the 35. That will be $6,500. Advertising expense, we didn't change anything in our adjusting entries for advertising, so we're just going to go back to the unadjusted trial balance and just copy the balance we had over there. That was $500. So $500 goes down here. And then what else do we have? We had prepaid rent and unearned revenue. So prepaid rent and unearned revenue. The unearned revenue, it used to be $2,000 in the unadjusted trial balance, and then our adjusting entries, it was debited by $1,000, which is a decrease in the unearned revenue, because remember, it's a liability account. Liabilities will decrease with a debit. Okay, so 2,000 credit balance minus 1,000, that will make it $1,000 remaining balance under the credit for the unearned revenue. And then we forgot the prepaid rent. The prepaid rent, it used to be $1,200. And then let's look at the adjusting entries. There was a credit of $100. Okay, so 1,200 minus the 100, because debit balance and a credit balance, debit minus credit, that will be 1,200 minus 100. That's $1,100 debit balance for prepaid rent. Okay, so the remaining balance is $1,100. We still have $1,100 of prepaid rent. It decreased by 100 because we consumed it. We consumed $100 during that month. It was transferred to an expense account. Okay, now what else? So from the unadjusted trial balance, we took all the accounts. Let's go back to the adjusting entries and find out if there was something that we did not record yet. Rent expense, it wasn't there, so we're going to go ahead and add it to the trial balance. Rent expense, it has a debit balance of $100. Okay, and then let's continue looking. So look at the accounts one by one. So rent expense and then prepaid rent, we considered that already. We're done with this. Supplies expense, it looks like we did not record supplies expense yet. I mean, we did not show that in the trial balance. So $300 debit balance for supplies expense. That is a $300 debit balance. And then the supplies, we already did that. We considered it. Unearned revenue, we did that. Service revenue, we already did that. Let's continue. we had the depreciation expense and accumulated depreciation. Those were not recorded yet. Depreciation expense is a debit balance account. Depreciation expense, that was 267. And then accumulated depreciation, it's a contra asset account. And it has a credit balance, so that would be a 267 credit. And then continue scrolling down. Salaries expense, salaries payable. Okay, so salaries expense was not recorded yet. That was $2,500. Salaries expense. $2,500. And then the salaries payable, we already did that. Interest expense is the last one that we still have to record. Interest expense for $300. Interest expense for $300. Okay, and then just double check what you did. Just go back to each and every account. Make sure that you did not forget anything. That's number one. Number two, make sure that you copied the correct amount, or you did your math properly when you recorded, when you considered the adjustments and you reflected those amounts from the adjustments to the existing amounts you had in the unadjusted trial balance. Make sure you did your math right. After you do that, okay, and also make sure that you have the amount under the debit or credit. Make sure it's in the right place. If it was a debit balance, it has to be under debit. If it's credit, then credit. And then you add the totals. And as you know, the purpose of the trial balance is to make sure that our total debits will equal the total credits. So after adding all the total debits and total credits, I came up with $116,567 on both sides. Okay. If you did not get them equal, definitely you did something wrong. If you got them equal, most probably you did not do anything wrong, but it doesn't mean that 100% you didn't do anything wrong. Okay. So if you're still not sure that there was no mistake, you need to go back and check that you transferred the numbers correctly and you did your math correctly and you did not forget anything and you put the debit under the debit and the credit under credit, not flipped. Okay, that's how you check. All right. Okay, so that was that's all for this video. And then in the next video, we'll talk about how to prepare the financial statements, which is the next step after preparing the adjusted trial balance.